the jobs report is more than just a headline number. There's the household survey, the establishment survey, the jobless rate, and of course, wage growth. Over the past 12 months, average hourly earnings have increased by 4.1%. For many economists and market strategists, this metric often seems to be a show stealer. But why, you might be asking yourself. And what is it telling us? Joining us now, we've got Ross Mack, personal finance expert, founder of Maconomics as well. Ross, why should people be focusing in on this wage year-over-year number? It came in at 4.1%.
Yeah, I will say one, Brad, thanks for having me. I think we have to understand, right? It's a very interesting, delicate equation, right? The dichotomy between wages and inflation, right? So on paper, when we see wages increase, I think it looks great. However, we have to understand that it's a double-edged sword. Sometimes there's an unintended consequence when it comes to wages actually increasing, right? The unintended consequence is that when wages increase, sometimes employers, right, companies actually have to increase their prices, which the unintended consequence is that unfortunately inflation might remain higher for longer, which after this jobs number actually came out, one of the other headlines was that, this might actually make the Fed's job a lot harder, right? Does this actually lead the Fed to lowering rates in June, or if they lower it at all later this year? And so when you really think about it, right, as a normal American, people start to get a little frustrated when they think that maybe their wages aren't keeping up with the pace of cost of living.
You know, it's particularly interesting. We were speaking with the Conference Board Chief Economist Dana Peterson about this very topic of wages and especially how it correlates to what Americans actually feel. Of course, the Conference Board puts out their reading on consumer confidence. And as we look across the spectrum here, why do you think, Ross, that many Americans still feel like they might be drowning in expenses, drowning in costs, or combating inflation on their own personal battlefield as well, if wages are higher and inflation is decelerating or lower?
Yeah, well, we also just got to understand what's the starting point, right? Sure, inflation is coming down, wages are increasing, but you got to ask to what end, right? What was the actual starting point? Because as it stands, right, housing is more expensive, food is obviously more expensive, energy prices, right, gas prices, et cetera. So, not to beat a dead horse, but the thing is, you also have savings coming down. And so when it's all said and done, we have to understand that inflation is going to be a lot stickier, right? Employers are probably going to have to continue to increase prices. And for the small part of the economy who are feeling the benefits of wages increasing, well, guess what? That means their demand is higher, which also might keep prices higher. And so at the end of the day, whether we're talking housing, we have institutional investors now being landlords, right? Like housing is a very interesting conversation because when it's all said and done, you have effectively a finite supply and the demand is obviously continuously increasing. And that's why housing is so expensive.
Ross, we got to leave things there on the day here. Ross Mack, personal finance expert and founder of Maconomics. Good to see you.
Thank you.